income tax returns, because it is difficult to explain a tax credit program. We try to explain the benefit of the program, but how it actually works, we're going to show you a sample tax return of an actual home buyer that got into the program, so we can have a better idea of, just give a little visual on an actual tax return. Okay. So a little bit about the program. The MCC allows a borrower to claim a tax credit that reduces their tax liability. So we'll talk about tax liability. The MCCs are issued by the Pima County Industrial Development Authority, so the Pima County IDA, and it allows the home buyer to claim 40% of the interest they paid as a tax credit up to $2,000 per year. So we're going to talk tax credits. These credits can be claimed year after year as long as the borrower lives in the home and holds a mortgage, as long as they're paying interest. If the recipient doesn't have a tax liability or for any particular year does not file or use the credit actually rolls over for 3 years. So that's another benefit of the program, is it doesn't go away. Another plus is if you refinance, you don't lose the certificate, you don't have to requalify. You submit some paperwork and your certificate transfers over to the new loan and the interest you're paying on that loan. So a quick overview of how it works. Most importantly is the buyer needs to apply prior to closing. And if approved and the paperwork's done, you get issued a certificate, and the certificate is good for 30 years. And we report this to IRS, so IRS knows that you're allowed to be claiming this credit on your income tax returns. Breakdown of specifically how the program works here on this example. If you have a loan amount of $125,000 at 4% interest, the home buyer is going to pay $5,000 in just interest alone, which falls under the category of a deduction. So we'll talk deductions. What this credit does, it gives the home buyer 40% of the interest they pay as a tax credit. So 40% of the $5,000 in this example is $2,000. So their tax credit is $2,000. I specifically use this loan amount because people are capped at $2,000. So nobody's credit will exceed $2,000. So as long as the loan amount is above 125 and 4% interest, they're pretty much going to be getting $2,000 every year. So collectively, over the 30 years since the program had begun in 91, we did celebrate its 30-year anniversary in 2021. And in this example here, you'll see over the life of a loan, your typical home owner will save about $50,000 or receive $50,000 worth of credits. So in the example to the right, it's kind of small there. We sit down with your buyer and say, okay, here's your loan amount, here's your interest rate. This first column is telling you how much interest you're going to pay. And that's when we talk deductions. This credit gives them 40% of that number, but they're capped at $2,000. So you'll see in year 2, they start getting capped at $2,000. And then it's probably at least for the first 20 years that they're going to be seeing that $2,000 credit. So this is where we try to sit down with your home buyer and give them an example specifically on their loan amount, their interest rate, and show them the difference between deductions and credits. So here we're going to go into the difference between your tax deductions and your tax credits. So your deduction reduces how much your income is subject to taxes, and then the deductions lowers your taxable income. Now we'll talk about IRS gives us a standard deduction that is super high right now that most people don't itemize or write things off. So they go with the standard deduction. So they won't even be writing off the interest they're paying. Now, versus a credit, this credit, it directly reduces the amount of money you owe IRS, reducing your tax liability. So this $2,000 saves you $2,000. So when you're looking at the entire picture, which is better between deductions and credits, the credit is always better because it's dollar for dollar. And the deduction, IRS is giving you such a high deduction anyway, that it's a win-win on both sides. So here's an actual example of a 1040. Okay, this credit is only good on your federal income tax returns, not in state. So you'll see in this specific example, this person's wages on 1A was $66,000. Now, when we start talking deductions, we are going down to line 12. So you'll see here between line 1 and line 11, that's showing everyone, all your sources of income. Okay, so however you receive your income, and if there's multiple sources of incomes or W-2s. So in total, this person's income was $66,000. $164. Now, when I start talking about deductions and IRS giving a standard deduction, that's the highlighted area that you'll see there. For single or married, it's $12,950. So in that previous example, we showed you that that particular home buyer was paying $5,000 in just interest alone. That $5,000 is nowhere near the $12,000 figure. Is that what it says? Because I can't really see. Okay. And then if you're married, I gotta scroll down. I don't know if I can scroll down or you gotta scroll down. Sorry, I'm old and I'm blind. You'll see there, if you're married, the standard deduction is $25,000. Is that what it looks like? Sorry, I can't see. The $25,000, that's when we're talking about now. When you're married, you have $25,000 worth of a standard deduction. Now you got to find $25,000 worth of things to write off. So unless you have a really high mortgage and a really high interest rate, plus a whole bunch of other things to write off, you're probably going to take the $25,000 standard that IRS is giving you. So this is when we talk to your home buyers that yes, you're paying interest. You can write your interest off as a deduction, but most people are not. And your tax preparers are usually going to say, we're not putting your house on your taxes. And they're usually talking about deductions. So we have to remind the home buyers that this is separate from that. This is in addition, this is an actual tax credit. So yes, Mario, so married, it is $25,900, which is a high number. Okay, so to try to find that much to write off is quite a bit. So then if you go to the bottom there, after you get your 12, in this example, single person, the income was 66, they got the 12,950 deduction. So now on line 15 is what they call the taxable income. Okay, so the taxable income in this example is $53,000, $53,214. So I hope everybody can see that. I don't know if they need to scroll and to fit that in their screen. So at the very bottom, line 15, $53,214. That's the number IRS is saying, okay, I can tax you on that portion now. And it's of that number we want from you, you person filing tax returns. Okay, so that's what the first page is doing. The first page is saying, here's all the sources of income. Here's the standard deductions. Now here's, yeah, they can't see line 50. I can't see it either, but at the very bottom, it says the $53,214. Okay. All right, so then on to the next page is where our credits are going to kick in. Okay, so now we're talking tax credits. You see the entire section, there's tax credits. So this particular person, IRS is saying, okay, based off your taxable income, we want from you, homeowner, $7,300. So now that they determined we can tax you on the $53,000 figure, of that $53,000, we want from you $7,300. Most people are getting taxed. Okay, most people are paying IRS. A lot of people don't understand the process because they get a refund regardless. And most of us get refunds because we overpay through our pay stubs, which will show your home buyer also, and we'll show you that in a little bit in this same example. So IRS is saying, okay, we want from you $7,327. Now, if you go to line 20, you're going to start claiming credits here. Okay, so this is where you're going to claim your child tax credits, earned income credits, education credits. This is a housing credit. So it's in line with every other credit. So when you're filing TurboTax, if you're filing a paper return, which we'll show you, you're going to go to the credit section and you're going to find the MCC credit. And so this particular person, plugged in their $2,000 credit, and IRS is saying, okay, we don't want from you $7,300 anymore. Now you need to just give us $5,300. So that's on line 24. Now on 25, section 25 payments is saying, okay, how much money have you already given IRS? Okay, so you'll see here on 25A, this particular homeowner had withheld from their pay stubs $6,162. So IRS is saying, okay, we wanted $5,300 from you. You gave us 61, which is why on line 35, you're getting a refund of $835. Okay, so we're talking to your home buyers or homeowners. At this time, they're homeowners. We go and explain to them, and we show them specifically on their tax returns, this is how much money you're having withheld out of your paychecks. Now that you're going to have this tax credit that reduces what IRS wants from you, maybe you don't have to have as much money taken out of your paychecks, because that way you have more money in your pocket, and that's going to help make your payment more affordable now that you're in a housing payment. Okay, it might be higher than your rent, maybe not right now, but you know, those are kind of examples where we try to show the home buyers that we want to have them to be successful and be able to keep their mortgages and hopefully pay off their loan someday. So later on, I'm going to show you an example of someone, this same person, if they didn't have the credit, where not only did they not get a refund, they owed IRS money. Okay, so this is the basic first 2 pages of your 1040. We're trying to, this is an actual tax return. You know, it's very simple. This particular one is simple because they didn't have any children, any other credits. So this is beneficial for them. So on the next slide, we're going to go into how do you actually claim this credit? Like, what allows you to claim this credit? Well, first thing you have to look for is this 1098. So we're going to send instructions saying your lender's going to be sending you this 1098 every year with your January statement, with your invoice that your mortgage is due. And we're going to start highlighting, okay, look for this number. And on here, you'll see it talks about on line 1, they paid $5,300 in interest alone. So that's when we're talking deductions. They can claim that $5,300 as a deduction, but they are not, because the standard is so high. So they're going to be looking for this particular form. And then on the next slide, you're going to see where now you can actually start claiming the credit. So this 8396 belongs specifically to the MCC program. Every January, we send this to your certificate holder, and we say, here's an example of the form. Here are the different methods to claim it, depending on which product you're using. If you're using TurboTax, give it to your tax preparer. If you're doing it yourself, if you're having it prepared by VITA, which is the volunteer service, you know, they know how to put it into their particular program. But this is an actual IRS tax form, and it gets updated every year. So you'll see this one is 2022. So when that 1040 gets posted, so does this 8396. And it's this particular form that says, okay, you homeowner, and you'll see we try to type in there, it's pretty small, but it says who issued your MCC. And here's where you're going to see Pima County IDA. And then you got an actual certificate number and when the certificate is issued. And the reason that's important is because IRS knows, we've reported to IRS that you have a certificate, and this is verifying that you have a certificate and you can claim this credit. Because anyone that buys a home and paying interest can't start claiming the credit. They actually have to have a certificate, which is why this form asks for that information. So we issue that to your home buyer when they've purchased and gotten everything turned in, and that certificate is good for 30 years. So we have that issue date, and that way they know it is going for 30 years, and that's also on their certificate as an expiration date. Now, this particular form, on the first thing on line 1, it's saying, how much interest did you pay? So that's going to go back to that form where we tell your home buyer, go look for that 1098 that lender sent you, which was that $5,000 figure that you write as a deduction, but we're not right now, but you can still claim the credit. So here on line 1, you're going to put that $5,000 figure. And here's your credit rate. On line 2, you're allowed to claim 40% of the interest you pay. However, 40% of that 53 is a little bit above 2,000, but on the instructions on the page that follows is going to remind you you're capped at $2,000. So you'll see on line 3, that's their $2,000 credit. So all the way down to line 7, they're allowed to claim $2,000. Now on line 8, was that number, that $7,000 figure that we got from page 2 of 1040. Okay, that $7,000 was their taxable income. So it's on this section that it says, okay, maybe you didn't have a taxable income, or maybe your taxable income was only $5,000. No, also I'll use a smaller number. Maybe your taxable income was only $1,000. So they're saying, okay, well, you got a $2,000 credit. you can use 1,000 of that to wipe that taxable income out, and then you can carry over whatever it is you're not using. And that's where that bottom section is. Part 2 is if you're carrying any money over, especially around COVID, when people were unemployed and not filing tax returns, they were still allowed to keep their credit, but once they started working again, they were able to roll over up to 3 years. And it shows you here in this example, on line 4, 5, and 6, it's already asking you, are you bringing credit from any previous years? And then it's the bottom section that's going to say, are you carrying over to the next year or rolling over for the next 3 years? So that part of the carryover explanation and how much your credit is and if you can benefit from it happens on this tax form, on the 8396. Okay. So this next page is the back side of the 8396, which is the one that's telling you where you're capped at the $2,000 figure and how to look for that 1098 and where it goes and plugs in into your 1040 as a credit. Okay. So we're going to go back to that page 2 of that same person. Okay. Now here we're back at line 16. Their taxable income is $7,300. Okay, that's what IRS wants from them. Now, if they didn't have the $2,000 credit on line 24, IRS is going to say, okay, we still want from you $7,327 because you didn't have any credits. Now, they still had on line 25 the $6,100 taken out of their pay stubs, which means, okay, well, that's still not enough to cover what we want from you. So instead of them getting a refund because of the credit, they would actually owe $1,165 because they did not have that $2,000 credit. Okay, so that is how the credit works on the 1040. And we try to give examples of, well, what we do is when we meet with the home buyers, we look at their tax return and say, this is what's happening with you right now. And then when this 2,000 plugs in, this is what it's going to turn into. Okay. So that was like a quick overview on a tax return and the actual tax credit. Please, we're going to go ahead and take questions now because this is my first time actually presenting tax return piece of it. And if anyone has any questions specifically about how to claim it on their tax returns, again, it's good for 30 years as long as they're paying interest. We're going to send them that tax form every January, reminding them that they have this tax credit program. I don't know if there's anything in the chat. So this particular piece, we did pretty good. I was worried about timing because taxes are a scary thing that are all due next week, by the way, for any of those that are waiting like myself. Next week, they are due. And so if nobody has any questions on this particular piece, Nisa did mention we're going to send this out to you because that's helpful when you're kind of actually looking at tax returns and comparing it to yours. Because we get a lot of calls saying, I don't know if they put it on my tax returns or not. They need to stay in the home for 30 years. It's not transferable. Okay, so the question is, this certificate is actually issued to this home you're purchasing. If you refinance, you can keep the certificate, but as soon as you move out of the home, it's no longer your primary residence, or if you sell it, the certificate goes away. Essentially, it's for that initial purchase with this MCC that you got. Okay, so if there's no more tax questions, which is great, this is exciting. I was a little worried. We're gonna go in, I'll get into that question. We're gonna go into the MCC part of it, how it works, but someone did ask in the chat a question about recapture. Okay, recapture is something that if the home buyer were to sell the home in the first 9 years, IRS could potentially say, we want some of our credits back. Now, the reason I say potentially is because I've been administering the program since 95. It's been around since 91. It's never happened. Okay. What IRS is saying, okay, if you sell your home within the next 9 years and your income goes beyond $200,000 a year, you sell your home and you double its profit, you sell it for double what you purchased. There has to be all these different criteria that have to be met in order for IRS to say, okay, we want some of our credits back. that we want some of those $2,000 we may have given you. So there's this 4-page formula that's not the easiest to fill out, but that's something we'll explain to your home buyer when they're in the buying process, that there's potentially this recapture if you happen to sell your home within the first 9 years, but the chances of it happening is pretty much zero at this point. Okay, unless you start making a ton of money and you sell that home for a ton of money and make a ton of money, then IRS is going to be like, okay, we want some of our $2,000 back. But doesn't typically happen in the first, not both things. Your value don't go up that high and your income don't typically go up. Both of those things happen in the first 9 years. Okay, so that was a brief part about recapture. If anyone has more questions about that, you actually, the forms I think are actually on our website with the application, but we'll be happy to have that discussion with anybody else. Okay, so we're going to go into the program eligibility, how to apply, and more. Okay. Okay, so the program geography. The program is currently and now available statewide. There's just a handful of states in Arizona that still issue the program. I want to say 4 or 5. I don't think there's more than 5 states. And again, we are the only ones that administer it, CIC, for the entire state of Arizona. So available all of Arizona. There is what they call target areas. Now, the target area is considered an economically distressed area, but that's not necessarily the case anymore. For instance, here in Tucson, there's a big area that used to be considered target, and that's not the case anymore. Now it's, you know, a higher end part of town, expensive homes that a lot of people can't afford to purchase there anymore anyway. So it's based off census tracts. There's certain census tracts that are considered target. And the benefit of purchasing in a target area is you do not have to be a first-time home buyer. Your income limit and your purchase price limits are higher. And you'll see here if you visit our website, we have a map. On the next page, we're going to do a quick video that kind of shows you what you're going to see on our website. I don't know if it's a video, but it's a little. So you'll see there, what's a target area? You'll click into this map, and you can either in the search map area, you put the address, or you can actually zoom in, and this is a whole state, and you'll see the green is what's considered non-target, the yellows are target. So as you start zooming in, you'll see through the particular part of town you're looking at, oh, this particular section is considered target. So it just depends on where you're purchasing. There's pockets throughout Tucson, Phoenix, Buckeye. I saw we did close one in Buckeye. So they're kind of just scattered everywhere. So it's not just all in a specific place. They're everywhere. So this map is very helpful if you're trying to determine if it's in a target area because they're not a first-time buyer or the income and the price limits are higher. Okay. So here's more eligibility requirements. Okay, so what's most important that you're going to be looking to see if you qualify or if your home buyer qualifies is we'll go over the income and price limits, but the main thing is they have to be a first-time home buyer or not owned a home in the last 3 years. Now there's a couple exceptions to that rule. If they're a veteran or if they're buying in a targeted area, they do not have to be a first-time home buyer. Now, all homes qualify. Single family, manufactured, condos, duplex is the most they'll go. They won't go beyond a duplex. So your triplex, your quad, because then now you're more of a commercial. And so, and townhouses. So pretty much every home does qualify. And all loans qualify. Your FHA, VA, USDA, conventional, all loans, all down payment assistance products, the Home Buyer Solutions Program, which is a loan product that comes with down payment assistance that also through the IDAs here locally. So any product it can work with. We don't get into ratios. We don't look at much of the loan. We actually try to stay out of the closing process as much as possible. Now there's the income limit and the purchase price limit. So you'll see to the right, it's based off the county that they're purchasing in. And then again, the first part on the income limits is family size. So the first box, all Arizona, that'd be Pima County. That's where Tucson would fall. So a family of 1 to 2, they can't make more than $82,800 if they're buying in a non-target area. If they're buying in a target area, they can make closer to $100,000 a year. Now, if there's 3 or more in the family, you'll see in a non-target, it's 95,220. In a target area, it goes up to 115. Now, these are 2022's income limits. It has been posted that the income limits are due to increase. They will increase, but they're not officially been released. So we're hoping to get income limits and purchase price limits increased, because purchase price limits are hurting us a little bit in Maricopa County. So you'll see here under all other counties and their purchase price limits for in a non-target area in Tucson. So right here in this example, it's 349. In a target area, they can go up to 427. In Maricopa County, which is your Phoenix, your bigger area there, in a non-target area, it's 366.9. So, you know, it's tough to find something in Maricopa for that price. And then a target area is 448. Now, the plus side is we've been marketing and expanding into Maricopa County, and we've actually had at least 40 people coming through the program, and we've issued at least 20 to 25 certificates in just this quarter. So people are qualifying. There are houses out there. So we're just trying to spread the word, you know, get it out there that this program exists. So, and down there is the azzmcc.org. We'll talk a little bit about everything you're going to find there on our website, but this is kind of general eligibility criteria. Okay. Again, this is a brief overview of how the program works. Now, depending on who my audience is I can go out and do presentations. If you do lunch and learns, you know, your realtors, your lenders, or if you do anything for home buyers. But this particular form is showing, depending again who the audience is. So the first box is kind of your standard. This is for your home buyer. This is how it works. So if you're ever trying to explain the program, you got this loan amount at 4% interest, $5,000, what you're going to pay in interest alone. This credit gives you 40% of that. So your credit's going to be $2,000. So that's how we market it to your home buyers. $2,000 tax credit for the life of the loan, as long as they're paying interest. Now, the plus for your lender, it says here, increase your buying loan eligibility. Okay, so what your mortgage company can do or your lender can do is they can take that $2,000 as if it were income. Okay, so that $2,000 divided by 12 is $166.67 per month. So on your lender's residential loan application, on their 1003, there's actually a drop box that has income, other income, that says mortgage credit certificate. This is where your lender would plug in this 166. Okay, and what this number does is it saves a lot of deals, especially right now with interest rates fluctuating, and maybe they qualified when the rate was 6%, but they didn't lock their rate, and now the rate is 7%. Okay, and they don't qualify anymore. So now your lender, if they can put this 166 into that loan, they'll qualify at that 7%. Now, one thing we will work with your home buyers, again, when we were talking about tax returns and the money taken out of their paychecks, yes, they qualify for that 7% rate now, but that means their mortgage payment's going to be higher. And this 166 isn't true money that they're going to see. We remind them it's still a tax credit. So we'll sit down with the home buyer and show them on their tax return, this is how much money you're getting withheld from your paychecks to cover the, you know, the credit that you're going to have now. So in this example, you'll see the $2,000 tax credit. If they get paid bi-weekly, we let them know you can go adjust your withholdings so that you can take more money home per paycheck, which again is going to help you make that mortgage payment that might be higher if the lender put this money in there to help you qualify for that higher interest rate. Or at the bottom there, I put the 166 means more house. Okay, we have a lot of times where those home buyers qualify for 280, and that 166 got them now to 300,000, because that's, you know, our market right now. So that's, you know, where if I'm talking to real estate agents, it's like this program truly helps not only your home buyer once they're in their home, you know, great sale to say, hey, remember me, I, you know, referred you to this $2,000 program, but it's also getting them into that house that they may have not been able to afford, or with these interest rates moving all around, you know, it's just saving the deals. We have a lot of lenders are, let's just put it in there just in case. Okay. So why should I recommend to my borrowers? Okay, it helps qualify for a higher loan amount. CIC will feature you on your social media. Okay, so you'll see that, especially we'll give shout outs that, you know, we received this many from Maricopa County, or this lender's killing it, or if you're doing a presentation that I'm going to go and do with you, you know, for hosting a presentation, you know, if you create a flyer, things like that, we post those. So we share that information. And we have all channels, all social media channels. And it's a unique opportunity for Arizona residents. Okay, so remember, there's not very many states that do the MCC anymore. There's no class required, because that's always asked, and it will not slow down your closing process. Okay, we will meet with the applicant, and we usually can turn, if we need to, we'll turn an approval letter around the same day, because that's what your underwriter might need. But 24 to 48 hours is how quickly we can turn things around. So happy home buyers equal more referrals. And I'll cover in a little bit the actual process, the application process, kind of. Okay, so how to share with interested home buyers. Okay, we understand explaining the program is tricky. What we just went through is a lot of information. And I know it's hard, buying a home is already complicated. So, you know, throwing this into the mix doesn't make things easier. Okay, so that's why a lot of times people won't even mention the program, because they don't want to complicate things. But, you know, by not mentioning the program, the buyer didn't get in prior to closing, and now they're losing out in $50,000 worth of credits. Okay, so what we try to do is, you'll see here on our website, you're going to find there's an actual video that we created that explains how to claim the credit, how the program works in 3 minutes. So that way you can even share that with your home buyer. And when your buyer applies, we actually send them a link to that video, just so they can go take a look at it and see what it's really about. You'll find on there the income limit and the price limits. So that's something we'll announce when there is an increase. So if you're on our newsletter, if you're signed up to receive our information, we will, you know, let you know that there's been an increase in the limits. And then on our website, you will also find the application. So if you want to download the application, fill it out yourself. We have a lot of people that still are hands-on, they'll do it themselves. And then they can upload it safely and securely through our website. They are also able to, on our website, schedule an appointment, be like, I want to go in and I want to talk to somebody, or I want to do it via email. Or we have people that take a picture of the page, of each page, and they text it to us. You know, we try to make it as easy as possible. All the information is on the website, and all the documents are in Spanish, and our staff is also bilingual. So we have, you'll see here, just 4 of us in the home ownership department. Okay, so this is the staff, and I don't know how many, I know I've seen a couple of you here. So again, I'm Patty, the director of the homeownership team, and then Mario is the homeownership manager, Suzanne and Jessica. Jessica is the one that works mostly with the down payment assistance, which we also do administer when your buyers are applying for down payment assistance. We typically are the ones that wire the money to the title company. So if you guys are ever having issues or questions with that, but Suzanne is your primary contact that is looking at the emails that are coming in, sending out the scripted application process, the video, the document, everything you need. And your home buyers can meet with Mario or Suzanne if they want to come in, or even if they want to do a phone call, Zoom, Teams, whatever it is they want to do. We're trying to make the process as easy as possible. There is the website just for MCCs, and it actually has its own email. Okay, so mcc@cictucson.org, its own phone number, its own staff. So we're really here to make the process as quickly and as easy as possible. Okay. So again, thanks for your time. And then again, you can schedule a training. You know, I can go out and do a training, or if you want to come in and meet with our staff and be like, you know, can you show me about the program? And then there's our website and the email. I see a question there about the non-qualifying cosigner. Okay, cosigners get a little tricky. If they're not occupying the home, they wouldn't qualify, essentially, because it's like, I'm the daughter buying the house, but mom's going to cosign, but she already has her own house. Okay, so it's typically the people that are on the loan that would be the ones qualifying. So co-signers are a tricky thing.
There's another question. If a borrower receives income from child support or spousal maintenance, does that have to be counted in household income, even if not being used for lender qualifying? Or is it only if lender is using that income to qualify the borrower?
So when we're looking at different sources of income, especially child support, it can be retracted, taken out. I don't know what the right word is, especially because it's not guaranteed. So I might have a court order that I should be receiving $600 a month, but the parent is not paying it. So that's not something we're going to count. You know, we're looking at their last 3 years of tax returns. And then we're looking at what the lender is using for income. Okay, and then based off that, we'll look at the limit and try to see what we can do, especially like if you have a home buyer that gets overtime. And we know that overtime there might be seasonal. So it's not something we're going to count for the entire year. Okay, so we can look at their income qualification. There was a question there about the fee. Okay, there is a fee to get into the program. There's a one-time $500 program fee. Now that what I do see a lot is if your lender is using the program to qualify, for instance, putting that 166 in your loan, your lender can collect that at closing. So it could be considered a closing cost. So if your sellers contributed towards closing costs, it's a third-party fee that we send an invoice and it can get paid if they're getting down payment assistance. I know it gets thrown into the loan also. So it can be paid from their closing directly to us. If the home buyer wants to, if this is not part of the closing process or being used to qualify, we'll work with your home buyer once they move in the home and allow payments. Okay, so right now we're doing as much as $50 a month, $100 a month, whatever they can afford, because technically they're not going to start claiming it until January of 2024. So that fee is something we'll work with the home buyer. And then there is a $100 renewal fee, but that's not going to kick in until they're actually seeing the $2,000 benefit. Okay, we're going to send them, here's a tax form. This is how you claim it. Don't forget you have this credit. Here's examples of how we're in the process of making a video similar to what we just shared with you, so they know exactly what to look for. And then once they see that they've benefited and they've gotten the actual credit, that's when they pay that $100 renewal fee. Okay. And if for some reason they didn't benefit or they're going to carry over and they're not going to use it, then we waive the fee. Okay. So that's not something that's due and it's a case by case. So those are the two fees involved. I don't know if you see any more questions. Yeah, so wow, 145, we're doing pretty good. I was a little concerned